So, you probably heard of ETFs, exchange traded funds, and wonder just what they are and why everyone seems so obsessed with them. I mean, these things are like mysterious black boxes that hold a bunch of stocks, right? And suddenly, people are buying and selling them as if their livelihood depends on it. Let's peel back the layers and explain how an ETF actually works under the hood. Imagine you're building a house of cards. Each card is a stock or bond. Now, instead of just stacking these alone, what if you could make a giant structure by gluing all these cards together into a single entity? That's kind of what an ETF does. It's like taking a bunch of different stocks and bundling them up neatly so that people can buy the whole package as one neat little investment. ETFs are popular because they offer something called diversification. It's like spreading your jam across several slices of bread instead of putting all of it on just one slice. This means you're not putting all your eggs in one basket, which is great if you want to reduce risk. Plus, ETFs can track a specific index, like the S&P 500 or the Dow Jones. It's as if you're buying an entire slice of that big pie without having to pick each piece yourself. But here's the surprising part. These ETFs aren't just static slices of pie. They're dynamic, which means they have a bit of flexibility. For example, let's say the S&P 500 drops by a certain percentage. The ETF will... So, you see, creating an ETF is like playing a high-stakes game where everyone has to keep their promises and work together. It's not about buying and selling in the traditional sense. It's more about managing a basket of assets that collectively represent something bigger. And here's the surprising part. When you think about how an ETF actually works, there's a fascinating group called authorized participants, APs, that play a crucial role. Think of APs as the behind-the-scenes magicians who keep everything in line. Imagine you have a big toy box filled with all sorts of toys, some small, some medium, and some big ones. You want to share these toys equally among your friends, but sometimes you might need to add or take away a few to make sure everyone gets exactly the same type and amount of playtime. In the world of ETFs, APs are like those toy box magicians. They're typically large financial institutions who have a special agreement with the ETF issuer. Their job is to monitor the basket of securities that makes up the ETF, let's call it the toys in our example, and ensure that they match the underlying index. Now, there comes a time when more people want to buy ETF shares than usual. It might be because everyone suddenly loves space toys, or in ETF terms, because an index is performing well. In this case, APs come into play by exchanging baskets of securities for new ETF shares. They literally bring the toys from their toy box and trade them with a new batch of ETF shares. This helps ensure that the value of each ETF share remains close to its net asset value, NAV, just like making sure everyone gets an equal amount of playtime. But what if fewer people want to buy ETFs than usual? APs can do the opposite. Redeem their ETF shares for baskets of securities. They take back a few toys from your toy box and put them away, ensuring that there aren't too many ETF shares floating around that could dilute their value. By doing this, APs help ensure that the ETF stays as close as possible to its target index, maintaining stability and fairness in the market. It's like a continuous game of checkers to keep everything perfectly balanced. So remember, when you see an ETF performing well or poorly, part of that performance can be attributed to these behind-the-scenes magicians, the authorized participants making sure the value stays true to its underlying assets. Now that we understand who the authorized participants are and their role in creating and redeeming shares, let's dive into how the price of an ETF actually works. You might think the price of an ETF is just like buying a stock, determined by supply and demand. But there's more to it than meets the eye. So, here's the question. How does the price of an ETF differ from its net asset value, NAV, and why should you care? First, the net asset value, NAV, of an ETF is like the fund's balance sheet. It's calculated by the fund manager at the end of each trading day based on the market value of all the underlying assets in the ETF. Think of it as the total worth of everything the ETF owns, divided by the number of shares outstanding. And here's the surprising part. Unlike stocks, which trade throughout the day and can be influenced by real-time supply and demand, the NAV only gets updated once a day. This means that when you check the price of an ETF on your phone or computer during trading hours, it's not exactly the same as its NAV. For example, let's say you own an ETF that tracks the performance of technology stocks. By the end of the day, if the market value of those tech stocks has increased significantly, the NAV will also rise. But until the next day, when a new NAV is calculated, your ETF shares might still trade at a slightly different price based on supply and demand. This difference between the ETF's price, which can fluctuate during the day, and its NAV, which only updates once daily, means that sometimes you might find yourself buying or selling at a slight premium or discount to the fund's true value. This is why many traders keep an eye on both numbers, especially when looking for arbitrage opportunities. Now that we've covered how pricing and trading work in the market, let's bust a myth or two about ETFs. Many people believe that ETFs are just like mutual funds, but with more flexibility. This is a common misconception. So let's dive into this. Imagine you're at a bakery, and there are two types of pies, a traditional apple pie and an ETF pie. The traditional apple pie is made by a single baker who carefully measures the ingredients and bakes it to perfection. Similarly, mutual funds are managed by fund managers who pick stocks, bonds, or other assets, then distribute them among investors. But now, let's look at the ETF pie. This isn't just baked in one way. It can be transformed on the fly. The unique part in ETF is that its value isn't set by a single entity, but by buyers and sellers in the market. Traders can create or redeem shares based on the underlying assets. Think of this as having a pie-making station where you can make your own apple pie if you want, or combine it with other pies to create something new. And here's the surprising part. When you buy an ETF, you're actually buying into a basket of stocks or bonds that is passively managed, meaning there isn't a single person picking each stock. Instead, a group of index providers like MSCI or S&P 500 determine which assets should be in the basket, and these baskets are then replicated by the fund. So, while mutual funds can have higher fees because they require active management, ETFs often have lower costs because their structure allows for more passive management. Mutual funds also typically trade only once a day after the market closes, whereas ETFs can be bought or sold throughout the trading session. Understanding this distinction is crucial for making informed investment decisions. Knowing that you're not just buying into a managed fund, but a basket of assets with dynamic creation and redemption processes helps explain why ETFs are so popular among investors looking for efficiency and flexibility. And there we have it. ETFs aren't just magical investment vehicles. They're like a well-organized team working together to keep things fair. An ETF works by tracking an index through a basket of securities, which means it's not just buying and holding a bunch of stocks or bonds willy-nilly. Instead, it's like having a captain who knows exactly what needs to be done. The authorized participants are the key players here. Think of them as the referees making sure everything runs smoothly. They create new shares when demand is high by bringing in enough cash to buy all those underlying securities. And they redeem shares when there's less interest, essentially selling off some of those securities for the money. This process keeps the supply and demand balanced and, ideally, the ETF's price right on track with its net asset value. So, let's recap. You thought ETFs were just some fancy trading tool? Nope. They're actually a clever way to make sure your investments match up perfectly with what you're tracking. And that's why their prices generally stay close to their net asset values. It's like having a trusty map that guides you through the financial landscape. Now, isn't it amazing how much clearer everything is? If you'll never look at an ETF or any financial concept the same way again, what do you think you should do next?